Committee met on the 19th and the 20th of September 2016 amidst conditions of persistently subdued global and domestic economic and financial environments. The committee thoroughly assessed the global and domestic macroeconomic and financial developments and risks to the domestic economy up to September 2016 and the outlook for the last quarter of the year. In attendance were 10 out of 12 members. The committee acknowledged the tepid growth performance of global output arising from legacy factors, the June 23rd Brexit vote, as well as contagion from emerging markets, weak demand, and contracting productivity. Whereas growth appears to be slowly recovering in the advanced economies, especially in the United States, the path forward remains fraught with uncertainty as long-term government bonds have nosedived to multi-year lows on expectations of looser monetary policy from the advanced economies and the continued suboptimal performance of the euro area, Japan, and China. Consequently, the IMF had in July 2016 further downgraded its baseline forecast for global growth to 3.1% from 3.2% in April. The World Bank, in its June 2016 report on global economic prospects, showed even less optimism and gave a global output growth projection of 2.4% from 2016 from the 2.9% projected in January. The subdued global growth prospects is traced to persistently weak fundamentals, mainly in emerging markets and developing economies, mostly due to soft commodity prices, diminished investments, contracting trade, weak demand, and rising inflation. Volatility in global financial markets appear to have subsided in the second quarter of the year after a wild ride following the UK Brexit vote and against the backdrop of less likely US rate hike expectations and some stability in the crude oil market. The United States economy firmed up at a seasonally adjusted annualized rate of 1.1% in the second quarter of 2016, although with a downward adjustment of 0.1% from the first estimate of 1.2%. It is, however, still a noticeable improvement compared with the 0.8% growth recorded during the first quarter of 2016. The improved performance of the economy was attributed to improvements in private consumption spending, a robust labor market, and increased exports, even as retail sales and manufacturing output witnessed a decline. Japan's economy expanded at a seasonally adjusted annualized rate of 0.2% during the second quarter of 2016, compared with 1.7% during the first quarter of 2016. Against the backdrop of weak wage growth, uncertain global economic outlook, and an external sector that is undermined by a strong yen. Fearing that monetary policy may be approaching its limits, the government on 2nd of August approved a fiscal stimulus of 13.5 trillion Japanese yen, approximately $132 billion, in a spirited attempt to jumpstart the economy, even as the Bank of Japan dismissed market speculation that it was planning to stop its monthly monetary stimulus program of 6.7 trillion yen, approximately $69.07 billion. The massive fiscal and monetary stimulus are, however, to have the desired impact. Real GDP in the euro area expanded by 0.3%, a significant decline compared with 0.6% recorded during the first quarter of 2016. Downside risks from the Brexit vote seems to have dissipated, with no attendant major economic shock to the zone's economy thus far. As such, many of the conditions that have driven the recovery have remained in place, suggesting that third quarter growth may continue in the direction of the second quarter. Following its September 8, 2016 meeting, the Governing Council of the European Central Bank resolved to leave its key interest rates on the main refinancing operations, the marginal lending facility, and the deposit facility unchanged at 0, 0.25, and minus 0.4% respectively. The Council also reaffirmed its commitment to sustain the monthly asset purchases of 80 billion euros, approximately $90 billion, until the end of March 2017, or until a sustained adjustment is seen on the path of inflation towards the 2% policy target. The Bank of England, at its August 4th meeting, and in attempts to further blunt the aftershocks of the Brexit vote, decided to cut its benchmark interest rate for the first time since 2009 by 25 basis points from 0.5% to 0.25%, the lowest ever in the bank's history. The committee voted to increase its monthly assets purchase program, financed through the issuance of reserves, by another £60 billion, approximately $80 billion, from £375 billion, approximately $502 billion, to £435 billion, approximately $582 billion. Furthermore, the Bank of England revived its financial crisis era UK government bond buying program, financed through its issuance of reserves up to £10 billion in an effort to stimulate the economy and steer inflation towards its 2% target. While major emerging markets and developing economies continue to be constrained by low inbound capital mobility, the intractable macroeconomic environment faced in 2015 and up to the first half of this year is gradually abating. The prospects for near-term full economic and financial recovery in the EMDEs remain subdued, with the IMF projected growth rate forecast for this group of countries at 4.1%, a downward review from 4.3% projected in its April update. However, resurgence of growth is expected to be powered by rising credits and a surge in government spending. The potential alliance between the OPEC and non-OPEC members like Russia to reduce quota in the face of disruptions to production in Nigeria, Libya, and Iraq have aided relative stability in the crude oil market. Global general price levels remained tapered due to sustained low oil and other commodity prices. In the advanced economies, despite the uncertainties arising from the UK referendum, accommodative stance of the zone's central banks, negative interest rates in Japan and elsewhere, as well as various fiscal stimuli, global inflation has remained suppressed. As deviations in macroeconomic fundamentals in the advanced economies and the emerging market and developing economies widened, monetary policy could continue to diverge between the two in the short to medium term. Domestic economic and financial developments. Data released by the National Bureau of Statistics in September indicated that the economy had slipped into recession following another contraction of the economy during the second quarter of 2016. The August 2016 data showed that domestic output during the second quarter of 2016 to have contracted by 0.06%. This represented a decline of 1.7 percentage points in output from minus 0.36% recorded during the first quarter and 4.41 percentage points lower than the 2.35% growth in the corresponding period of 2015. The non-oil sector contracted by 0.38% compared with 0.18% contraction in the preceding quarter. Agriculture, other services, education, arts, entertainment, and recreation, and information and communication grew by 4.53%, 4.32%, 2.88%, 1.8%, and 1.35%, respectively. The shocks associated with energy shortages and price hikes, scarcity of foreign exchange, and depressed consumer demand, among others, apparently proved to be more damaging than expected. Recognizing the conditions which precipitated the current economic downturn were not essentially sensitive to monetary policy interventions, the MPC again renewed its call for urgent complementary fiscal policies to resuscitate production and engineer aggregate consumption. In particular, members underscored the imperatives of diversification of the economy away from oil into agriculture, manufacturing, and services, as well as more efforts towards payment of salaries and arrears of public sector employees, particularly in states and local governments, to revamp and stimulate aggregate consumption as part of the overall fiscal policy menu kit. On the supply side, efforts must be intensified at increased capital expenditure to reduce infrastructural deficits, improve the business environment, and spur the badly needed growth. Prices. The committee noted the headline inflation year-on-year again rose in August to 17.6% from 17.1% in July 2016, thus maintaining the upward trend since January 2016. The increase in headline inflation in August reflected increases in both food and core components of inflation. Core and food inflation have increased from 16.93% and 15.8% in July to 17.2% and 16.43% respectively in August 2016. The committee nonetheless noted that the month-on-month evolution of consumer price inflation has been less phenomenal. The headline inflation index rose by 1% in August, from 1.3% in July, 1.7% in June, and 2.8% in May, when it last rose. Similarly, the core index has been increasing at a decreasing rate since May, when it rose by 2.7%. It moderated to 0.85% in August, from 1.22% in July, and 1.83% in June. The same pattern of moderation is seen in the food index, which rose by 1.2% in August, from 1.21% in July, 1.4% in June, and 2.6% in May. The Monetary Policy Committee further noted that the pressure on consumer prices continues to be hugely associated with reforms, related legacy, and structural factors including high cost of electricity, transport, production inputs, as well as higher prices of both domestic and imported food products owing to the depreciation of the naira. The MPC expects that with the onset of the harvest season, the restrictive stance of policy, as well as a flexible foreign exchange regime, prices will begin to taper in the fourth quarter of the year. Monetary, credit, and financial markets developments. Broad money supply grew by 8.08% in August 2016, compared with the July level of 10.75%. When analyzed, M2 grew by 12.12% in August 2016 against the growth benchmark of 10.98% for 2016. Net domestic credit grew by 20.09% in the same period and annualized at 30.14%. At this rate, the growth rate of net domestic credit was above the provisional benchmark of 17.94% for 2016. The development in the net domestic credit essentially reflected the relative growth in credit to the private sector of 21.07% in the month, annualized to 31.61%. Credit to government grew by 1.99% in August 2016, which annualized to a growth of 3% compared with the benchmark growth of 13.28%. The growth in M2 was traced to exchange rate effect following the depreciation of Naira in the second quarter of the year. Money market interest rates reflected liquidity conditions in the economy. Average interbank core rate, which stood at 15% on 8 July 2016, closed at 30% on August 26, 2016. Between July 8 and 26 August 2016, interbank core rates averaged 24.95%. The rates increased to 50% on July 15, 2016. The sharp increase was attributed to the drop in net liquidity during the period. The committee noted a decline in the equity segment of the capital market as the all-share index fell by 3.51% from 28,733.9 on July 18, 2016 to 27,725.4 on September 15, 2016. Similarly, market capitalization declined by 3.55% from 9.87 trillion naira to 9.52 trillion naira during the same period. In addition, relative to end of December 2015, the indices fell by 20.06% and 3.35% respectively, reflecting the slowdown in the economy. Overall, the capital market did not show vulnerabilities to domestic and external sector developments. The external sector developments. The average Naira exchange rate weakened at the interbank segment of the foreign exchange market during the review period. The exchange rate at the interbank market opened at 285.25 Naira to the dollar and closed at 305.9 Naira to the dollar, with a daily average of 302.87 Naira to the dollar between July 1st and August 26, 2016. The committee observed that total foreign exchange inflows through the CBN increased by 89.14% from $1.092 billion recorded in July to $2.065 billion in August 2016. This increase was mainly due to receipts of foreign flows within the month. Total outflows, however, decreased by 4.57% from $2.7 billion to $2.6 billion during the same period. In direct efforts to deepen the foreign exchange market and stabilize the financial markets generally, a number of policy instruments were deployed since the last Monetary Policy Committee meeting, including an increase in the benchmark interest rates. Complementary administrative measures were also taken towards achieving this goal, among which was the directive to IMTUs to sell forex directly to bureau de change operators in order to improve liquidity in that segment of the foreign exchange market. While challenges remained, committee expressed optimism that with the crystallization of current policy measures, noticeable improvements should be observed in the financial markets going forward. The committee's considerations. The committee acknowledged the weak macroeconomic performance and the challenges confronting the economy, but noted that the Monetary Policy Committee had consistently called attention to the implications of the absence of robust fiscal policy to complement monetary policy in the past. The committee also assessed the impact of its decision to tighten the stance of monetary policy by raising the monetary policy rate in July 2016. At this time, The committee understood the complexity of the challenges facing the economy and the difficulty of arriving at an optimal policy mix to address rising inflation and economic contraction simultaneously. The committee also recognized that monetary policy had been substantially burdened since 2009 and had been stretched. The committee noted with relish that new capital flows into the economy, approximately $1 billion, had come in since July, while month-on-month inflation had declined continuously since May of 2016. Against this background, members re-emphasized the need to prioritize the use of monetary policy instruments in dealing essentially with stability issues around key prices, consumer price and exchange rate as a prerequisite for growth. The MPC noted that stagflation is indeed a very difficult economic condition with no quick fixes, having been imposed by supply shocks as well as fiscal and current account twin deficits. Consequently, the policy framework must be re-engineered urgently to provide a lever for reversing the negative growth trend. While the imperative for ensuring financial system stability remains, the MPC reiterated the fact that monetary policy alone cannot move the economy out of stagflation. The Monetary Policy Committee considered the numerous analysis and calls for rates reduction, but came to the conclusion that the greatest challenges facing the economy today remains unsystematic and incomplete structural reforms which raise costs, risks, and uncertainty. The calls came mainly from the belief that reducing interest rates will spur credit growth, not only in the private sector, but also by the public sector, which will help provide liquidity to stimulate consumption and investment spending. The committee was of the view that in the past, the MPC had cut rates to achieve the above objectives, but found that rather than deploy the available liquidity to provide credit to agriculture and manufacturing sectors, the rate cuts provided opportunities for lending to traders who deployed the same liquidity in putting pressure on the foreign exchange market, which had limited supply, thus pushing up exchange rate. With respect to providing opportunity to public sector to borrow at lower rates, to boost consumption and investment spending, the committee agreed that although it was expected to stimulate growth through aggressive spending, doing so without corresponding efforts to boost industrial output by taking actions to deepen foreign exchange supply for raw materials will not help reduce unemployment, nor will it boost industrial capacities. The committee was also of the view that consumer demand for goods, which will be boosted through increased spending, may indeed be chasing too few goods, which may further exacerbate the already heightened inflationary conditions. The urgency of monetary and fiscal policy retreat along the trade and budgetary policy to design comprehensive intervention mechanisms is long overdue. The bank has since 2009 expanded its balance sheet to bail out the financial system and support growth initiatives in the economy, while stimulating economic growth and creating a congenial investment climate always is and remains essentially the realm of fiscal policy, while monetary policy in all cases comes in to support sound fiscal policy. The bank has and shall continue to deploy its development finance interventions to complement the overall efforts of fiscal policy towards reinvigorating the economy. The interest rate decisions of the bank are therefore anchored on sound judgment and fundamentals and compelling arguments for such policy interventions. The committee also feels that there was the need to continue to encourage the inflow of foreign capital into the economy by continuing to put in place incentives to gain the confidence of players in this segment of the foreign exchange market. Consequently, committee considers that loosening monetary policy now is not advisable as real interest rates are negative, pressure exists on the foreign exchange market while inflation is trending upwards. Committee noted the positive response of the deposit money banks to the bank's call for increased credit to the private sector in between July and August. As the growth in monetary aggregate spiked above their provisional benchmarks, headline inflation continued its upward trajectory in August 2016 and now close to twice the size of the upper limit of the policy reference band. Supply-side factors including energy and utility prices, transportation and input costs have continued to add to consumer price pressures. Members emphasized that improved fiscal activities, especially the active implementation of the 2016 federal budget and payment of salaries by states and local governments, will go a long way in contributing to economic recovery. In the same direction, the committee urged the fiscal authorities to consider tax incentives as a stimulus on both supply and demand side of economic activities. Outlook. The data available to the committee and forecast of key variables suggest that the outlook for inflation in the medium term appears benign based on several indicators. First, month-on-month inflation has since May 2016 turned the curve. Second, harvests have started to kick in for most agricultural produce and should contribute to dampening consumer prices in the months ahead. And third, the current stance of monetary policy is expected to continue to help lock in expectations of inflation, which, by the way, has started to improve with the gradual return of stability in the foreign exchange market. In this light, the Monetary Policy Committee believes that as inflows improve, the Naira exchange rate should further stabilize. Overall, the major pressure points remain the challenges in the oil sector, and here we mean production and prices, output contraction, rise in NPLs in the banking system, and other financial system vulnerabilities, as well as foreign exchange shortages. The committee's decision. The committee assessed the relevant risks and concluded that the economy continues to face elevated risks on both price and output fronts. However, given its primary mandate and considering its limitations of its instruments with respect to output, committee elected to retain the restrictive stance of policy evoked at its last meeting when it raised the monetary policy rate from 12 to 14%. Conscious of the need to allow these and other measures like the foreign exchange reforms to work through fully, it decided to retain all monetary policy instruments at their current levels. In summary, all 10 Monetary Policy Committee members voted as follows. 1. Retain the MPR at 14%, retain the CRR at 22.5%, retain the liquidity ratio at 30%, and retain the asymmetric window at plus 200 and minus 500 basis points around the MPR. I thank you for listening.